before we get started, make sure you subscribe to our channel. And if you're on YouTube, make sure you click on the bell notification so that you get notified of all of our upcoming videos. All right, so I am here with Alina. And welcome to Real Estate Life 360. This is an episode where I'm going to be interviewing Alina on the passive investing via syndications. And just to start off with, I guess my initial question to you, Alina, is what does that mean by passive investing via syndication? Let's assume that nobody knows what syndication is, and just give a little background as to what. Maybe let's first introduce yourself. Sorry about that. So,
Sure.
introduce yourself on who you are, what you do, and how you, I guess, got into this topic of syndications.
Sure. Hi, everyone. Thank you, Paul, for having me. It's a real pleasure to be interviewed here. So my name is Alina Trigub. I am the founding member of the SAMO Financial. It's a boutique private equity company that concentrates solely on helping people to become passive investors and build their wealth by passively investing in syndications. And I'll start with how I got into this and gradually explain what syndications are. So about 6 years ago, I started looking for investments locally by where you and I live in Northern New Jersey, and I couldn't find anything. I'm a former tax accountant, and so taxes are always in the back of my mind. As someone who is in a higher tax bracket, I've always been thinking about how to minimize the taxes for my husband and myself. And as one of the strategies, real estate has been on my mind, but I haven't taken any action. So when I started looking about 6 years ago, I started looking locally, naturally, as everyone else does. And the numbers would never make sense. And after doing that for about 10 months, I decided that I have to go out of state. And while I was researching different strategies to go out of state and buy and hold investments out of state, one strategy came up. It was called Syndications, and I decided to look into it and see how it works. So essentially what syndications mean is that a group of people decides to pool money together to buy a large real estate, and it's nothing more than that. Just syndication essentially is pooling money together to buy something large. So we can make a parallel between buying a single family house. So when you buy a single family house, you have down payment, you have closing costs, and you have renovation costs. The same here. Let's say instead of single family, we want to buy an apartment complex. When we buy an apartment complex, it's essentially the same process, just on a much grander scale. Instead of costing maybe 500,000, now it's going to cost 5 million or 50 million. So what we do, we group people together into a partnership, and the partnership has general partners, people that do all the work, and then limited partners, which are essentially passive investors, people that put their funds and let the general partners do all the work. But in terms of the cost, it's the same thing. We have closing costs, we have renovation costs, and we have down payment. So same type of cost, just on a much grander scale, and that's why we need to have a group of people instead of one individual doing it together. And that's what I do now, and I help people that are either busy business owners or busy professionals that have too much going on in their life, want to be real estate investors, want to take tax advantages of real estate investing, just simply do not have the bandwidth. I help them join our partnership, and make passive residual income, and then save on taxes, and then see the results of this type of investing by looking at the properties that we buy and improving them, and seeing how we beautifying the communities and helping other people that are tenants in our communities see a better future for themselves by living in something bigger and better.
Okay, that was a mouthful, but I guess for those that are new to this, okay, and what I usually like to do is, on my interviews, or I like to invite people that actually doing it. And so I want everybody, I guess, who's watching this to understand that, people that I invite to my interviews or this interviews on Real Estate Life 360 are people that are actually doing it. And so just to kind of give a little background, because I do remember it was about maybe 5-6 years ago, we had this discussion,
Yeah.
and you mentioned that you were, going into looking into multifamily. That's when we were doing the meetups,
Yep.
and I congratulate you on taking initiative and moving forward and taking action on what you said. What were the first, I guess, how many syndications have you been involved with or have you invested in since you got started?
Sure. I've invested somewhere between 12 to 16, I would say at this point. I don't remember the exact number, but again, so when I started out as passive investor, just like what I'm helping other people to become these days. And
Okay.
I've invested in a bunch of syndications that were buying apartment complexes, essentially. And why apartments? Because it's something that close to home. I used to live in an apartment building when I was younger, going to college, and I understood that strategy. I understood that asset class. It made sense to me, and that's why it was natural, and it's kind of natural and common for a lot of other folks to start their investing in syndications by investing in the apartment complexes. But gradually over time, as I saw the need to expand this to create my own company so I could help other people, I saw the need to diversify further, because my initial thought process was I need to diversify my portfolio. In addition to having Wall Street stuff, stocks, bonds, mutual funds, ETFs, I need to have something outside of Wall Street. And that's where syndications came to mind. Now, a lot of people ask the difference between REITs, real estate investment trusts, and
Right.
syndications. And just on a very high level, REITs essentially work just like mutual funds. The difference is real estate investment trust concentrates on real estate only. Mutual funds could be utilities, technology, everything else. So it's just another name for a mutual fund that concentrates on real estate. But the income they produce is still ordinary income, taxed at your personal W-2 tax rate if you're an employee, which means it's going to be taxed if you're in a higher tax bracket. It's still going to be taxed at 30, 35, 37, whatever your percentage is.
Mm-hmm.
Where what we do, syndications, allows you to tax the income that's produced at a much lower rate. Number one, when we buy property, there is always depreciation involved. So essentially, in the beginning, in the first several years, most likely your tax form will show losses instead of gains, even though you'll be getting tax distributions during the year. The tax form will show losses. That's number one. Number two, when the property is sold and that passive income gain is netted against your former losses, whatever is left can only be taxed at a maximum of 20%, and essentially long-term capital losses, which are taxed anywhere between 15 to 20%. So that's a huge savings overall, considering that, you'll get significant gain. So that's the significant difference that exists between what Wall Street does and what syndications offer. And that's why I really, as a former tax accountant, I really do like this strategy. So I started with multifamily and gradually realized the need for further diversification. So I started looking at other asset classes, what else we can invest in. So I added mobile home parks to our portfolio, and then I added storage to our portfolio. And the new class that I'm invested in is assisted living. And again, we know that there's a growing senior population, and there is a growing demand for the housing for the senior population. So it's definitely in the area that's expanding. Granted, it's not everywhere. It differs from market to market, but it's something that's in high demand. So these are the asset classes that I'm in. And Currently, I am looking into the other asset classes outside of real estate, things like, for instance, oil and gas and other things, because the more diversified portfolio we have, the greater chance that it will be better balanced. And when there is market fluctuations, your hit will be minimized by such diversification.
So let me get this clear. So syndications, I mean, so you can have syndications not only for apartments, but you can have it for other
Absolutely.
assets.
Absolutely.
Um,
Anything you like.
but I guess what is typically the like minimum amount that one needs to have or invest in order to, I guess, would you say buy in or to
Invest.
become to invest in a syndication?
Sure. So, first of all, syndications are regulated by SEC, Securities and Exchange Commission, which
Okay.
essentially entails that SEC imposes certain rules and requirements for people to that want to invest. So, in order to be able to invest in syndications, depending on which ruling is used, you have to, as an investor, qualify for these rules. So there are two classes essentially. First class is called accredited investors, and that definition is currently being under the improvement, if you will, from SEC. They're trying to update the definition of accredited and non-accredited investor. But the original baseline definition is you can be accredited investors by one or two options. First option is by income. If you're married, you need to be making at least 300,000 for the last 2 years in income, and you should reasonably believe that you will continue making just as much down the line. If you're single, you should be making at least 200,000 a year, and again, you should reasonably believe that you'll continue making at least 200,000 down the line. Or the alternative to be a accredited investor is by your net worth. And your net worth must be at least $1 million excluding your home. So what it means is it's your assets minus your liabilities, debts, mortgage, and so forth, will determine your net worth, but that excludes your primary residence. And you can be accredited by either your net worth or your income. It's either or, it doesn't have to be both.
Okay.
Another option for investors is if you're not accredited, the non-accredited investors, as sometimes people call it, sophisticated. These are the people that essentially understand basic finance, basic investing, understand the terms and how investment works, but they don't qualify by net worth or the income requirements. And for these folks, there are syndications that use the ruling to include some non-accredited investors. It's actually up to 35, but they're not as common as the ones for accredited investors. So once you're qualified by either being accredited or non-accredited, and depending on the ruling that the general partners decide to use, typically syndications start around $50,000.
Okay.
Nowadays, there are many crowdfunding platforms, and crowdfunding platforms use other rulings that allow people to join syndications at a much lower entry point, and typically they allow for a lot of non-accredited investors and probably start around $5,000 to $10,000. I've never used them. I mean, they have really good platforms, and I know a lot of my friends use their platforms as a software, but not as a service. And these are for folks that want to start out at a much lower entry point. But for more serious investors, people that are commonly accredited, syndications start at 50,000 and can go higher to 7,500 and even above that. Again, depending on how much capital is being raised, depending on the size of the investment that we're purchasing. Sorry for the long answer, but
No, it's okay. So I guess for syndications, let's say, if somebody wanted to, if somebody's looking for a syndication, and then, where does one go about looking for these syndications? Is it by word of mouth? Is there, a place, a venue, or
Sure.
just
Sure. So there are multiple things. Google is a beautiful thing. You can always search, type the word syndication, clubs, real estate. Another way to find it is through meetups. I, for instance, host two meetups. One is in New Jersey here by Essenberg County. Another one is in the city. And while my concentration is syndications, we always cover other topics as well. In addition to that, there are plenty of conferences on syndications and on real estate in general. Plus, meetup.com has a lot of different real estate clubs where people talk about syndications and beyond. And Bigger Pockets, the site that I personally call the Google of real estate, has a ton of topics that cover syndications. So I would say all of the above would be pretty good sources of finding syndications or investors, whether they're active or passive. And one way or another, you'll definitely be able to come across someone who is investing it. And these days, these don't have to be local. For instance, in my case, the first few syndications I invested in, neither the properties nor the general partners were local to me. I mean, it was a huge step, and I was very worried. But after doing my due diligence and research, I decided to take action, and I invested with people that I've never met in my life. And I mean, it turned out to be good investments.
awesome, awesome. So if somebody wanted to invest in a syndication, and this is just a question that just kind of popped into my head, um, are they, how long, I mean, is it something that's liquid, meaning that you can get out, or is it something that you're kind of stuck in until 5, 10, 20 years? I don't know. So I
Sure.
guess, that's my, so for somebody that has, 50,000, or for that matter, 100,000, and it's their, let's say, life saving or forever, or for that matter, is this something that you would recommend, I guess, for somebody that has their, as, savings 100,000, or is it something that you need, what if somebody needs their money back, what is the liquidity factor in that?
Sure. Great question, Paul. So my personal rule number one, if
Hmm.
50,000 is someone's life savings, I
Yeah,
would say do not invest in syndications. I personally believe that you need to have emergency fund money set aside, and
gotcha.
they should be in a very liquid account, savings or money market, whatever it is, but they should be easily available to you. The money that you put into syndications should be the money that you specifically allocated for investing and that you will not be needing in the next, let's say, 5 to 10 years.
Gotcha.
Typically, when we offer investments in syndications, the paperwork materials, the offering documents will have projections, and the projections will be shown for either 5 years, maybe 7 or 10. And that essentially means that we're estimating to hold such property for, let's say, 10 years, which means that we may sell the property at the year 10, but we can also sell this property at year 2 or year 12. So it just means that we're thinking we're going to hold it for about 10 years. But I always tell that to my investors up front. These are the money that are specifically for investments. You will not need them in the next 10 years. And that's why only put the money that you have after you have the emergency fund set aside. So that's very, very important. In terms of the liquidity, this is probably one of the least liquid investments. That being said, if someone has a situation that they, for instance, need to borrow money for some short period of time, they can approach the general partner and see if there are ways to potentially get a loan and do some sort of engagement in terms of borrowing the money. But I don't want people going into syndication with the assumption in mind that they'll be able to get the money back in a couple of years or whenever they need to, because this is not the type of investment. That being said, there are some properties that we were able to sell in a couple of years. But again, it's not a guarantee, so I don't want people to go into syndication with that assumption.
So you're looking at this as a long-term,
Correct.
investment. Good.
Especially now when everyone is talking about potential correction,
Yeah.
when that correction is going to happen. If it does happen, what's important for us that the property continues to cash flow, but we go through that cycle and allow the property to somewhat appreciate so we can sell it at a gain versus a loss, but we want to be able to live through that cycle, and that's why it's very critical to be able to stay in the investment for the needed duration and not look for those money.
Gotcha. Okay. The other, I guess, on a personal level, I wanted to ask you is why did you decide? I guess you answered that at the beginning when you were explaining, why not go and purchase multi-units and why, go into this syndication. Um, I guess you answered it before was that you weren't able to find properties that made sense financially in our area, which is New Jersey or tri-state, New
Yep.
Jersey, New York area.
Yeah. For me, and again, it's a matter of personal choice. I've been looking locally for about 10 months, and for me personally, the numbers just didn't make sense. And I was looking for small multis, like 2 to 4 units, residential multifamily. I couldn't find anything, and that's why my next choice was go out of state. And while I was researching out of state strategies, syndications came up, and that's why I started digging into it. And it looked like a viable strategy for someone who's working full time, has a family, has very little time.
Yeah.
This looked good, and that's why I took a chance. It was very, very hard to do the first investment, but after that, second, third, and fourth, so forth, it became a no-brainer. Granted, I still did my due diligence, but it was a lot easier to do because the more I invested, the more syndications I invested in, the more I understood how the process works, and the easier it became to read the documentations and to make the decision to invest. So it became, second nature at some point, and it required no time. Again, other than that upfront commitment of 5 to 10 hours, depending how much people want to spend on it, on reviewing everything, doing due diligence, talking to general partners. There's nothing else. Once you invest, your work is done. There's no more work. So for someone who is busy and doesn't want to spend a lot of time on real estate investing, but does want to invest in real estate, this is absolutely perfect strategy to diversify their portfolio.
Okay. While you were speaking, something just popped in my head, which was about due diligence. And on that, I want to ask you twofold is what are your top 3 due diligence things that you look for or things that you do to do your due diligence? And the second part to that is what materials or information can you provide that maybe somebody that doesn't know anything about syndications, is there some information out there that you would recommend to people to read up on?
Sure, absolutely. So when researching a specific syndication investment, I would say there are 3 steps. It's reviewing the deal sponsor, the general partner, which is the same thing, reviewing the market, and the third one is reviewing the deal itself. So the way it works is first reviewing the deal partner. So you want to look at their background, the prior experience, their track record. You want to interview the person, and while interviewing, you want to make sure that you have alignment in terms of the strategies, what they are telling you resonates with you personally, and it's the person that you feel comfortable investing with in the long run, because the investment will be in the long run. Once you've done that component, then you look at the market. Let's say they concentrate on Arizona. Arizona is pretty hot these days. People are looking at that market. The jobs are flocking in. The people are moving into Arizona. The climate is pretty decent overall. So you want to look at what specifically is going on in the state, and then the MSA, the metropolitan area where the investment is located and see
Okay.
whether that particular area is on the path to progress or not, and whether it's the area where it makes sense to invest, or maybe it's somewhere middle of nowhere and over 80 to 100 miles to the major MSA, then it may not be a good place to invest potentially. Again, have nothing against secondary, tertiary markets, but you really need to do a due diligence to see whether the area itself makes sense in general, and then for that specific asset class. Let's say you're investing in storages. The perfect area for storages may not be the same as perfect area for apartments, because storages need to be right next to highways, a busy area where a lot of cars pass by so they can see your storage, where for your apartment building you want to be a little bit inside so there's privacy, but it's close to, let's say, shopping centers, supermarkets and stuff, so restaurants, and then you do have easy way to get on the highway so people can get to work. So certain things are different depending on the asset class, but certain things are similar for the asset classes. So that's the second component you look at. And again, I'm going on a very high level. The third component is the deal itself. And what I tell people when looking at the deal itself, when you're reviewing the document, the executive summary that details all of those components, the general partner, the market, and then the investment, obviously you look at the comps, but then you also look at the numbers, and the numbers include such things as cash on cash, IRR, equity multiple. Don't just look at the investment says that my cash on cash return is 10%. It's good. Yes, maybe 10% cash on cash is good, but look at it in conjunction with everything else, and not only the quantitative but also qualitative. Both analysis need to be looked at together. Where this area is going, what are the comps dictating? Are the comps showing that, let's say if it's an apartment complex, that the rents can be raised? What are the numbers are telling me in conjunction with one another? Do they make sense? Some people invest for the immediate cash flow. Some people are more patient and have the ability to invest for the future appreciation, depending on the type of investor you are. Look at what the story tells you about this investment. Does this matches your overall strategy? And if that's the case, then potentially go into it. But that's the type of analysis you need to do. Now, in terms of where to find this information, I always suggest to people to read the books, and I have plenty. I have actually a whole library of books that I recommend people. But read about the asset class itself that you want to invest in.
Okay.
Read about commercial investing in general. I would start with two of the David Lindahl books, Multifamily Millions. I forget what the other one is, but he wrote two books, and both are incredibly great deep dive books into the commercial real estate and multifamily investing.
Okay, I'll put those notes. If you could send me
Sure.
a list of those books, references, I'll put them in the show notes.
Sure.
On our interview.
Yep.
Let
Yeah,
me.
books. I wrote a bunch of white papers. I can share that with you as well. Plus, podcasts are great way for people that are on the move and want to listen. There are tons of interviews, podcast interviews that they can learn about syndications in general and different asset classes. Plus, through networking, by going to real estate events, by coming to our event, for instance, by speaking with like-minded investors that are either active or passive investors. We have both. And learning about how the process works, what type of investing, what's involved in general is a good way to educate yourself and start taking action.
Yeah, I mean, I've actually from the one time that I went to your meetup, I actually met a gentleman, and he's an active investor. So these are people that are actually investing in either multi-units or syndications, and so
Sure.
and that's what I like about going to meetups with there are actually people there that are actually doing things, and not just necessarily just going there to I guess new people that are just going to learn, but it's a good mix of people that were
Exactly.
there.
Exactly.
So where would people find you? And I guess if you don't mind sharing your information, there'll be whatever you want to share with our community. That'll be great.
Sure. People can find me on alinatrigub.com or samofinancial.com. And again, I can send you all those links. Or LinkedIn, Instagram, Facebook, or Bigger Pockets. I'm pretty much in on a lot of social media platforms and available
Yeah,
to
if
answer
you
questions.
if you type her name, I'm sure she'll show up on
Yep,
any of the social media
I
platform.
will.
All
Yes.
right. Any last minute word of wisdom or advice to our community before we, I guess, finish the interview?
Yeah, absolutely, Paul. So I also started out as other folks that are listening without having much knowledge about real estate investing in general. My advice to anyone who wants to invest is to learn first about different strategies that are out there and don't just jump into it. First, learn what it takes, talk to people that are doing it and have been successful in it, learn from the best. There's absolutely no need to reinvent the wheels. You can learn from people that are crushing it, whatever you want to be, note investor, flipper, syndicator, passive investor. Learn it first and then take action.
Yeah, I
That's my
mean, I just think that, when people say real estate investing, they just think of like, there's so many, there's so many things out there that, a lot of options, there's, wholesaling, rehabbing,
yeah.
syndications, multi-units, note investing. So there's so many options out there. And so your advice is very well taken that, learn, the various techniques and then don't reinvent the wheel. So.
Agree, agree.
All right. All right. Thank you, Alina, for taking time out of your busy day, especially this time. I hope to see you in the near future.
Absolutely, Paul. It's my pleasure. I'm glad to share some nuggets of wisdom with your community and happy to help out to anyone interested. And thank you for inviting me to be
All
interviewed.
right. Thank you.